Hey, what's going on, everyone? Sal here with a quick video, and today I want to talk about improving capital efficiency in non-directional trades using futures options. Now, non-directional trading is the direction I've really been going into as I've been learning more and more about options, and at this point, I've really fallen in love with how non-directional trading allows me to be right even when I'm wrong. So even when I believe the stock is going to go up $3 or $4, I may be able to take a trade that allows me to make some money on it, giving me the ability to bet on either side of the direction and still be able to make money. Ladies and gentlemen, the thing about trading non-directionally using equities is that it required that I put up a significant amount of capital. But over the last couple weeks, I have learned about how to lower my equity requirement, or excuse me, capital requirement, and still be able to make a significant return on my investment. And I'm going to teach you guys how to do that right now. So let's get straight into it. Again, capital efficiency on non-directional trades using options on futures. So what is non-directional trading for people who don't know? With non-directional trading, we basically don't care about the direction that the underlying is moving. And I wouldn't say we don't care too much, but we basically are trading in a range, right? You can make money in any market using non-directional trading, but the gist of it is we care about the stock or the underlying being in a certain range, and we can bet on that range and make money on that. In exchange for higher probability of success, we accept a fixed award amount and also agree to put up larger than expected capital, excuse me, larger than typically capital for a already known expected award amount. So we are going to put up significantly more than what we're going to get back, but we're doing that because we understand the probability of success is much more in our favor. So what is capital efficiency? Capital efficiency, as described in the dictionary, is the informal ratio of output divided by capital expenditure. The larger the ratio, the better the capital efficiency. And we're going to learn about that a little bit more in this video. But basically, the translation is getting the biggest bang for your buck. And you do that trading options in futures. All right. So let's break it down. Some of the examples I want to show you. Different products, same underlying. We're going to go over the E-mini S&P contract and the SPY ETF. So just this small primer here, the E-mini S&P contract, it's a $50 weighted contract that offers market exposure to the S&P 500, tracks the 500 largest companies in the U.S. economy, right? So we're going to take that 50 times whatever that ETF is trading for. That's the notional value right there. When we talk about the SPY, we understand that that is an ETF, that is an exchange traded fund, which simply means a collection of securities, right? Trading under this one particular stock, right? Or fund ticker. So a collection of securities tracking the S&P 500. Interesting to note, there's actually a committee that chooses what stocks get into the ETF called the SPY. So it's not necessarily by market cap alone. It's actually a committee that chooses what goes in there. So it's not perfectly weighted exactly, but it does work, and it's very, very liquid for traders. All right. So let's go into our example. In this example, I'm going to use the iron condor trading on the futures market. So if you can zoom in a little bit here and or just watch this in bold, you'll be able to see that if we took this iron condor trade using the ES future, we're offered the ability to have this trade at 94% probability of success, right? The max loss on this trade is $9,460. But by using futures, we only have to put up a percentage, typically around 3 to 12% of the actual trade value, right? Or the actual max loss. So we see here that only $2,194.80 needs to be put up to make this trade happen. Again, at 94% probability of success. Now let's do this same trade, right? Pay attention to the fact that, again, this is a 41-day trade, right? We're only trading 4 contracts on each side of the trade. Now let's do this with equities, and you're going to see where the big difference lies here. All right, so now same trade, but we're using ETF equity options. And as you can see here, it requires significantly more contracts to deliver the same amount of max benefit. But look at the amount of required capital it takes to do this trade, significantly more than what it would take for you to do this on an equity a futures options trade. Again, still enjoying that 94% probability of success, but requires significantly more capital. So we're getting to the point where we're seeing that to be so much more successful in the stock market, it requires you to have so much money. Whereas in the futures market, you don't need to have that much money, but at the same time, you still benefit by having that higher probability of success. This results in growing your account substantially over a period of time. So let's even all of that out and get to the bottom of this. So here's the breakdown again on the Iron Condor. Using the SPY trade, the max benefit of this trade was $493. Max loss, $19,000. And again, look at this capital requirement, $19,000 to make $493 over the course of that time frame of the trade. Who's going to come up with that kind of money to make, $493? Now, if you're incredibly wealthy, it makes sense for you because the compounding of winning that trade over and over and over works in your favor over a 10, 20, 30-year time frame, because that's how long we want to trade, right? So as you can see with the ES Mini, we put up about the same amount of money. We gained probably much almost the same amount in terms of max profit, but look how much capital we actually have to put down. Very, very little capital. Again, with ES futures options, we're only putting up a portion of the capital required, yet still being able to generate significant return. This is why I've got to stress to you the importance of learning how to trade futures options. You put up a quarter, and then we talk about that 10 for 1. If you guys remember capital efficiency, where we talked about how that ratio is typically anywhere between a 10 to 1, 8 to 1, somewhere around there in terms of the return that you can, the leverage that you get using futures options. All right, so as you can see, ES and SPY there. All right, so let's go with one more example. Now we're going to use put verticals, all right, for short-term traders. For you guys who don't like to go that 41, 31 days out, again, we're going to use very realistic examples here in terms of capital amount. So let's, for example, believe that you're looking for the SPY to hold 300, right? So you believe this 300 is a wall and we're not going to go beyond that amount. Well, here on the SPY, we set up the trade using selling the 300 call against the 301 call, which we know on the ETF actually means 3010, right? If we go with the SPX. So 301 over the 300, we will be putting up for this trade $700, right? It's a nine-day trade, right? We put up $704 to generate a max profit of $396. Again, using these, September 16th, 9 days from now example, right? 396, we're putting up 704 on this 9-day example. Now let's look at the same trade using futures options. All right, so using futures options, we're going to sell the same thing, basically 300. And now this time we've got to sell because it's 5, right? So we're going by 5s when we talk about the ES because they're $5 wide. So we're going to go with the 3005, right, against the 3000. And we're going to believe the same thing, that 3,000 or 300 is going to be that wall and that the market will not go past that. And look at the capital efficiency using futures options, right? Max profit, basically the same. Max loss, basically almost the same. But look at the buying power efficiency. Only $130.29 needs to be put up to make this trade happen. Let's look at the bigger picture so you don't have to zoom in here, all right? So with the SPY, Max profit on this 9-day trade. Same again, because same 9 days, right? Same 9 days. I want you to focus on that same 9 days here. Nothing. I'm not no trickery here. $396 on the SPY. Max loss of 704. Capital required 704. Equity futures options. I'm confusing myself sometimes. Futures options. Max profit 330. Max loss 670. Capital required $130 to make this trade happen. I have been looking for a way to get traders who have $500 or less into the game. I have found it. This is a fucking game changer. This is a game changer, and this puts so many people who have been losing in the Forex, who have been losing equities trading, this puts you in the probability to finally be able to get into this game we call trading and be successful at it long term. This is incredible, guys, and I've fallen in love with this. So let's sum it up here. Benefits of trading using futures options: no PDT rule, better capital efficiency, lower taxes, unmatched liquidity. You can do your research on all of those things. I just wanted to keep this short and drop this out there for the people right now. More videos to come. I'm learning a lot. Can't wait to share it with you. Stay tuned. It's your boy Sal. Click subscribe if you haven't already subscribed. Until next time, take care.